Welcome to FireSide, a podcast from FS Investments. My name is Andrew Korz, Executive Director of Investment Research. And on today's episode, I am thrilled to be joined by Lara Rhame, our Chief U.S. Economist, to discuss our Q2 outlook for macro and markets. Lara, thank you for making the time.
Is it already Q2?
It is indeed Q2.
Q1 went fast.
April 3rd today.
Nice.
And what a Q1 it was. I think in a lot of ways, a continuation from the positivity we saw in 2023. If you consider all of the pillars of growth in our economy that drove such a strong year last year, whether it's the labor market, whether it's households, government spending, even businesses are now, it seems like, becoming a bit more, bullish on the outlook. There's a lot of good news out there.
Yeah, it's a long list of good news, that gives us momentum.
It is. And, I think during the first quarter, we saw the market take some rate cuts, sort of out of the curve.
Yeah.
But risk assets did just fine. The S&P 500 was up 10%. Credit spreads tightened further. So I think the first thing I want to get into is your growth outlook for Q2. So outside of some slightly higher inflation data in Q1, which we'll get to later, it's been a pretty good start, all things considered. I think we've gotten used to some wild swings quarter to quarter in terms of macro data. Things appear to be maybe settling into a more normal pattern now, where there's not this quarter to quarter volatility. Is that kind of what you're saying?
Yeah, I would agree with that. I think my underlying view of the economy in the second quarter is enjoy the ride. It's looking pretty good and don't overthink it. I think that is something that I am bringing to the conversations where people really are looking at risks and what we're watching, and market pricing shows that chance of recession has receded significantly. And yet there's still this lingering, I think, uncertainty from, so many investors. But, as we know, the economy wants to grow. And in any year, there's, call it a 15, 17% chance of a recession in any year. That's because some left tail event can happen and knock us off a growth path. But hey, where we sit today, all of the positives that you listed, I think are really important to remember, are giving us momentum. My forecast for this year, I've already had to upgrade it because things are so strong, looking like 2% for 2024. That's less than 3% last year, but it is a strong fundamental pace of growth.
Sure. So our job in research is to try to look around the corner, try to understand when markets and when people in general are being complacent about the outlook. There are some risks. It's not all positive right now. For Q2 specifically,
sure.
What are some of the biggest risks that you're watching?
I think, we have to acknowledge the fact that household delinquencies are rising, not mortgage delinquencies, which is by far and away the biggest chunk of household debt, but credit card delinquencies are back to levels that we haven't seen since the financial crisis. I put that at the feet of higher credit card interest rates. So those also being the highest that we've seen in a couple of decades. And auto loan delinquencies are also, 90-day delinquencies are quite high. It's worth watching because to me, it's more of a story that takes consumer spending from still like this YOLO, I'm going to pay $2,000 for a concert ticket and fly there to see the concert, to something that's a little more rational. I don't think that it's something that in and of itself causes a recession, but it certainly, I think, would cause consumption to look a little more rational. Second thing that I think we need to have on the radar is commodity prices. Oil's really jumped to the mid 80s. And when oil prices are $100 a barrel, I feel like that is problematic for companies. When gas prices are at $5 a gallon, and we are far away from that today. At a national average, we're like $3.50 a gallon, but that seems to be a psychological trigger for households that causes a doom spiral. And then obviously, in the background is the banking sector. I think still under pressure from unrealized losses. But again, I reiterate, this is a list of risks against a backdrop of really feeling pretty confident that today the economy has a lot of positive momentum and things are looking good.
Yeah, absolutely. So I think we would be remiss to talk about macro without discussing inflation.
Yeah.
And it's really been sort of the macro factor that's driven everything else over the past 2 to 3 years. I think it's the one thing that didn't cooperate from a data standpoint in Q1, right? think there's some important nuance here. The core CPI data came in hotter. Year-over-year rate still at 3.8. Core PCE looks a little better at 2.8. That's technically what sort of the Fed likes to look at. But I think it's fair to say that we've hit a bit of a speed bump back to 2% here. And again, I wouldn't be giving you the proper credit if I didn't mention that you've been spot on with your call here. You've talked all along about how much would need to go right for inflation to come all the way back to 2% and how challenging that could be. So walk me through how you're thinking about inflation right now and what that means for your Fed outlook.
Well, thank you for pointing out the place where I've been right.
I love to point out when you're wrong. So, I got to give.
We'll do that. We'll do that outside of the forum of this podcast. Yeah. So, this to me is really I think where markets have been too complacent is assuming that inflation's not only going to easily fit back into that 2% lane, but stay there reliably like it did for the 20 years before the pandemic. And I cannot emphasize enough how important that is. We really didn't talk about inflation for almost 2 decades. And today, not only are we still well above the Fed's target, but progress towards that target is stalled. And it's like swimsuit season, the last 5 pounds are the hardest, and it matters, know? So when we look at the components of inflation, that services piece is still really uncomfortably high. The Fed likes to shine a spotlight on that super core measure of core services, excluding housing. Because the idea being that piece really kind of ties to wage pressure that we're also seeing. And that has, over the last 3 months, reaccelerated. And I think, you put it together and it's a problematic picture that gives the Fed much less wiggle room to cut rates. And I think, combined with now the commodity price pressure that we're seeing, we had the ISM data out yesterday, the pricing pressure there was high. It's just, I really reiterate that my outlook is for the core PC deflator to remain above 2% this entire year. And I think in the second quarter, we're going to have to see if some of these, core commodity price pressures feed into the headline inflation numbers in an unfriendly way.
It's a bit of a whack-a-mole, right? Because you've kind of been able to stem the issue from goods with healing supply chains, and obviously demand from housing for durable goods has been pretty low. But all of a sudden you've got this issue where so much of what's gone on in inflation is rents coming down, and the Fed raising rates has sort of disincentivized new construction, new supply, which if we look out at another year or two, could just bring back that supply shortage in the housing market, which can just rev up rent growth again. So it really is this whack-a-mole, and you've been saying it again the whole time, how challenging it is to get that mixture right.
Yeah. And I think, this to me leads directly to the Fed, to markets through higher interest rates, because, you coined the phrase surgical rate cuts, that it's not going to be a easing program. Without a recession, we're not going to get one cut a meeting. We're not going to get one cut every quarter on autopilot. It's going to be surgical rate cuts. And I love that because it's like a nip and a tuck. They're going to have to get in there and figure out how markets and data and sentiment align to sneak in a rate cut. And we're just not there. Yeah. I mean, I think we had kind of said 2 to 3 at the start of the year. Markets today are pricing in 2 to 3. That's less than the dot plot. Yeah. This is the first time that the Fed has been more optimistic about their ability to cut rates. And yet, Fed, again, I don't like to bring up recent news because I know some folks may not be listening to this for a couple of weeks, but already only several days into the second quarter, we're seeing some of the Fed speakers coming out and saying we may only get 1 rate cut in the fourth quarter. So, I think we're very far from consensus on this, and it's really drifting fast. And, I think that surgical rate cut is what I want to leave people with. It is going to be careful, and it's lifting the whole interest rate complex higher. Yeah. And I mean, when you kind of think about it, for the Fed to cut rates, you kind of need one of 2 scenarios to happen. If growth is going to be strong, you need inflation data to be really, really benign. Right.
And if inflation data is going to be a bit above where they want it to be, you're going to need to see growth slow. And neither of those things are happening right now.
I think you and I discussed the fact that, if the Fed had to choose between two policy mistakes, I think the mistake of them easing too fast and having inflation reaccelerate would be literally their worst nightmare after they missed it so badly in 2022. So for that reason, and here I'm going to push back a little bit on the higher for longer phrasing, because as we take it from the Fed and we look at 2-year interest rates and 10-year interest rates, they're all moving up. But this idea that it's higher for longer, to me, implies that we're still on a trajectory back down to very low interest rates. The 10 years started the year around 4%. We're at 4.40 today. That's, I still think not in the second quarter, but sometime this year we retest 5%. And, you think about, to me, that's more of a renormalization to where we were in the 1990s and the early 2000s. I mean, this isn't just my Q2 outlook, it's yours too. I mean, I think the question that I get the most is, what does all of this mean for the economy? Like, can the economy operate with interest rates where they are today and maybe even a little higher? And my answer is yes, and real estate obviously is ground zero for that. So, this is residential, CRE, all top of mind. What's your Q2 outlook?
Yeah, I mean, real estate is a levered asset class, both in the housing market and in commercial real estate. And, kind of taking those one at a time. On the housing market, I think it's important probably to insert a little disclaimer here. I'm actively in the market for a home. So any views expressed here may be heavily skewed by my own challenging experience currently. But with all of that said,
I don't think you're alone.
No, I don't think so either.
You're a millennial too, so that's that's that whole generation's
I think a lot of listeners can probably understand my pain. But with all that said, the housing market did weather the surge in interest rates remarkably well, I think, all things considered, considering the pace and the magnitude of the rise in rates. And I should probably be more specific. The market weathered it well in some respects, right? So prices have remained elevated. The reduction in supply driven by higher mortgage rates has been greater than the reduction in demand. Employment market's been strong. Household balance sheets are really strong. Demand has stayed pretty okay despite the affordability issues.
Sure.
Home builders, right? So price stability and the lack of supply from the existing home market have kept construction activity pretty strong. Housing starts are well above pre-COVID levels. Home builder stock prices, if you check your Bloomberg, are really high. The one thing that hasn't been good is home sales, and it's hard to have sales if there aren't any homes in the market, and that's kind of been the issue.
It's a supply issue.
It's a supply issue.
I think that's really key. Like at the start of this rate hike cycle, it was a rates issue, and now it's a supply issue, and that everybody was waiting for this big correction lower in house prices, and it never came really.
Yeah, and I actually think
you missed it.
This is where Q2, I think we can really talk about how important the upcoming quarter is, because it's going to be really pivotal, right? It's the spring housing market season.
Sure, yes.
Super important. Selfishly, my hope is that we get this massive deluge of supply onto the market. I don't think that's going to happen, but I do think we are seeing a bit of a shift, right? There are signs that new listings are running well above last year. Still, record low supply, but better than last year. Hopefully gradually starting to get more homes on the market. You have not necessarily on, any relief on the rate side, where people are more incentivized to sell their homes. But you do have, as we've talked about a lot, life events come up, whether it's marriage, whether it's having kids, whether it's divorces, whatever it may be. People need to sell their homes. The more time goes on, the less willing they are to wait.
Sure, yeah.
And the last thing I would mention is that 40% of homes in the U.S. are owned outright with no mortgage. So there is this cohort of folks who own, mostly, older folks who own their homes with no financing, and they have a little bit more flexibility, but they also may not want to leave those homes. So there's a lot of sort of cross currents here that are hard to triangulate, but I think it all sort of leads to slightly increased supply on the market, which ultimately I think will come out in higher transactions, not necessarily lower home prices.
Sure. Sorry.
Yeah, no, it's that's okay. That's okay. My expectation is that, you know, home prices will just never come down from here. So I may as well just buy as soon as I can.
Well, and I think this is something that we could take through to other markets, right? Because it's this idea that the pace of the rate hike was so dramatic. You know, the most aggressive rate hike cycle that started in 2022 and kind of went into the middle of last year was the most aggressive since the 1980s. And I think, and you and I have talked about this a lot, it was the shock of the higher interest rates happening so fast, not necessarily the level of interest rates. I think, you know, I do talk to some younger folks who say, you know, I could never afford to buy a house now that mortgage rates are 7.5. And my answer is like the first house I bought, because I am, you know, a Gen Xer, was, you know, 9.25 mortgage rate. So, you know, we can have a robust real estate market. We can have a robust corporate credit market. We could have a robust M&A market with higher interest rates. It's just adjusting to the old normal. I'm going to say old normal, not new normal, the old normal, because it is this renormalization. I think the longer that we're here, the more that we will learn to swim in these waters. And, you know, I think the CRE market is obviously top of mind for so many investors as well, because the doomsday headlines keep coming. And you always talk me off the ledge with those. So I thank you for that. But is there anything you're watching in the second quarter for CRE? Does it sort of track this residential path?
Yeah, I think, you know, it's a little bit different because housing is maybe, you know, 25% institutional buyers who are looking for a return. CRE is almost entirely institutional. So it's going to be much more driven by, you know, return expectations and the ability to get return given sort of market prices, financing costs, relative to the housing market, where it's going to be like me, I just would like to buy a home. I'm not looking necessarily for a return, although that would be nice too. You know, I think investors have been on pause for the past, call it 18 to 20 months. There's been very few transactions in the market because, like I said, the cost of debt just makes it so that the clearing price in today's market makes it very challenging for those deals to pencil out in terms of returns. I do think actually, and we wrote about this a lot in our Q2 outlook, I do think we're seeing a shift that's not necessarily yet showing up in the hard data. You know, these sentiment measures, there's a lot of different trade groups in real estate that, you know, survey brokers, investors, lenders, et cetera. And pretty much all of them are showing significantly improved sentiment, outlook, et cetera, for the next 12 months relative to the past 12 months.
Oh, good. Like you can't have a recovery without animal spirits turning somehow.
That's usually the first thing. You know, cap rates have risen 100 to 150 basis points. That's not nearly as much as financing costs have risen, but for some buyers, whether you're, you know, using low leverage, maybe not as much debt, maybe you have a long investment horizon, these types of buyers, unlevered returns in real estate actually look pretty attractive right now. And then you have, as we've talked about, loan maturity starting to come up, which are going to require reappraisals from lenders to sort of, you know, get that sort of wheel of price discovery in motion. So when we look at Q2, I think there's a growing understanding in the market that rates are not coming to the rescue for commercial real estate, right? I don't think this better sentiment is predicated on rates coming down. I think it's predicated on them calming down.
Like it.
You like that?
I like it.
Yeah. Just coined that. But in all seriousness, I think investors need more certainty, right?
Yeah.
Financing costs are just such a big line item, you know, especially now, given how much rates have gone up. You can't go into a deal with no clear understanding whether your debt's going to cost 6% or 9% when it closes, right? Ultimately. So I think ultimately we do think the market is going to improve from an activity standpoint this year, maybe starting in Q2. But just kind of like the housing market, it's going to be slow going. It's going to be more of a trickle than a deluge. And I think the important distinction here is that more activity may not actually be good for prices, right? So it'll be good for price discovery, but what investors...
There's a little dip first,
what investors might actually discover is that prices are not, you know, have another 5 or 7% to drop before they sort of stabilize to these market interest rates. And so, you know, what does that mean for investors? This probably means equity returns remain fairly muted in the short to medium term. returns in debt are probably going to be more attractive going forward.
All right. So final plug for the Anatomy of a CRE Correction, which Andrew wrote and is just a fantastic piece on our website if you want to learn more about this market. I think, in juxtaposition to these slower moving real estate markets, I want to finish on the one market that is moving fast and furious, which is equities. And Andrew, you are also our equity guru. So are we just going to make a new record every week? Is that what is in store for us in the second quarter? Where are we going from these starting point of these stratospheric valuations?
Yeah. What an incredible 15 months it's been.
Really?
For our 401ks collectively, huh? The S&P 500 is up 40% since the end of 2022.
It's got to be one of the biggest asset moves in history.
10% last quarter. It's been up at least 7% in 4 of the last 5 quarters.
Yeah. That's
only happened 3 other times, 2021, 1983, and 1976. Just a remarkable, not only its magnitude, but in the consistency. It's just been up and to the right for the better part of 15 months.
And this is at a time when money supply is contracting and, the Fed is still quantitative tightening. It
flies in the face.
And the Fed is, Fed rate cuts are being, the market doesn't need Fed rate cuts to go up. We've priced a lot of those out.
I think what it's shown us is for the equity market to go up, low rates are one option, one possible force to drive equities up, but they are not a requirement for stocks to go up. But I do think the clear concern right now, as we've talked about a lot, is valuation, right? The S&P 500 is trading at 21 times next 12 months earnings. That's really high. That's, top sort of 5% going back through history. And it's not just the Mag 7, right? Everything pretty much within the US market, at least, outside of kind of defensives and energy, looks historically expensive right now. So here's what I think is going on. I think it's kind of 2 things. Number one, I think expectations for earnings growth are really strong for the next 2 years. 10% this year, 14% next year. Investors see no sign of earnings deceleration over their forecast horizon. So they're kind of willing to buy equities today based on 2026 earnings.
Sure.
Which, based on those earnings, multiples are more reasonable, around 17.5, still high. But basically, they're willing to let equities grow into their multiple, if that makes sense.
Yeah.
The other thing is obviously AI. And I think at the low end, AI has added probably $6 trillion to market cap in the US alone. That's very conservative.
Yeah.
And NVIDIA was responsible for a quarter of the market's return in Q1. Just remarkable. I think what makes AI such a powerful force is kind of twofold. First is it's profitable today. A lot of these, market narratives are sort of aspirational.
Right.
We're seeing it already in a lot of, specifically semiconductor stocks. It's cash flow generative today.
Yeah.
Right. And the second thing is it's open-ended to the upside, right? There's sort of a call option aspect to this because nobody knows how profitable this technology could be. It could be the most profitable thing of all time. And I want exposure to that bet, even if it's low-ish probability.
Yeah.
So I think over the next 3 months, we need to sort of acknowledge that these stocks have gone really far. The momentum factor had one of its best quarters ever in Q1. Usually throughout history, there's a pullback in momentum stocks. After that, so I sort of think in Q2, the biggest risks to the market continue to be any sign of earnings disappointment, growth disappointment, or any sign that the AI growth rate is sort of, we need to revise that down.
Right. So it sounds like you're not bearish on equities, but we've come really far, really fast. And we may just have sort of like a breath, pause here.
I think if things stay as they are, growth expectations can continue to be really strong. AI continues to just grow to the moon. There's really not much of a catalyst for a big pullback.
Right.
But I think we've priced in a lot of good news, and any chink in that armor, if you will, might sort of be cause for some sort of pullback.
All right. Well, it's going to be an interesting quarter, to be sure.
It is, and I think we'll sit here, 3 months from now and discuss how things went. But hopefully the economy stays as strong as it's been, and markets keep going up.
Yeah, I think we're going to be in good shape.
Yeah, awesome. Well, thanks for joining us, Lara, and I'll talk to you in 3 months.
Thank you. This episode was recorded at the FS Investments headquarters in Philadelphia's historic Navy Yard. It was produced by the investment research team. It was edited and engineered by Aaron Sherman. Video produced by Melissa Vendetti. and copy provided by Harrison Beck. Special thanks to show coordinators Ellie Zhang and Laura Coleman. If you enjoyed this episode, be sure to like and subscribe wherever you get your podcasts. Thanks for listening.